Good evening, everyone, and thanks very much for joining us. A very special live episode this evening. Hello to everyone who's watching us on Facebook, on Twitter, and also on YouTube. So thank you very much for joining us. This is episode, believe it or not, 125 of SCOTONOMICS. We occasionally do live episodes when we can get our guest on. We've got a guest this evening who's based in Glasgow, so that makes it much easier for us. So the first thing I'd like to do is welcome Andrew Berkeley, our guest for tonight, onto the show. Hello, Andrew. How are you doing?
Hello, William. I'm very good. Thank you. How are you?
Great. Yep, very well, thank you. Well, thank you so much for joining us. We'll just give a little introduction and then we'll get stuck into the questions. Now, what we're going to do, Andrew and I are going to work through these questions we've kind of agreed on, haven't we? I've probably thrown the odd curveball in there for you, Andrew, but we're going to go through this so we can get little sections covered, and then I'm going to take any of your questions or your comments, and Andrew's also going to chip in that kind of second part of the interview. But it's fairly structured because there's 5 key points or 5 key takeaways that I think you get from the paper, which we're going to discuss tonight, and then we'll go into all of the details and all of the questions. So we're going to speak about the self-financing state. And will I give it the full title, Andrew? The self-financing state, an institutional analysis of government expenditure, revenue collection and debt issuance operations in the United Kingdom. I think it's one of the most important pieces of economic research published in the UK in recent years. I think it's a groundbreaking paper that challenges conventional wisdom, something we like to do on SCOTONOMICS, that government spending in the UK is funded by either taxation or borrowing, or both. Now, the authors, and you're one of them, Andrew, have meticulously investigated the UK's legal and operational frameworks, most notably the role of the Consolidated Fund. So we're going to go into that in a little bit more detail. And they show that government spending always creates new money. Tax and debt issuance play a very different role than most people believe. Now, this is the first detailed institutional account of how public finance works in the UK. And we've got Andrew here to dig into all the details for us. Now, there's various ways of asking this one question, right? But actually, before we get into questions, I want to find out a little bit about you, Andrew. So could you tell us a little bit about yourself and how a senior specialist scientist in oceanology co-authored a now seminal paper in monetary operations?
Yeah, well, I'll try. My background is in oceanography, so I'm an oceanographer. I work in the offshore wind sector at the moment. I used to be an academic scientist about 10 or 15 years ago, sort of marine geology, oceanography, that sort of thing. So I've got a bit of a background in research, I suppose you could say, but it's not what I currently work in more sort of engineering side of oceanography. But yeah, I think probably like a lot of people, the global financial crisis in 2008, and then I think probably more specifically the sort of drive to austerity, which arrived in the UK at least around 2010, particularly around the 2010 election, got me asking various questions about, I guess the nature of economics, the nature of the economy, how it works, and how it affects, the government, constraints on the government and that sort of thing, because that was obviously paramount in the political rhetoric at the time, and that's probably to a greater or lesser degree ever since. And so I started to look into it, just as a hobby, obviously. It's still a hobby. And yeah, I mean, one of the first things I came across that struck a chord was some of the claims made by MMT, modern monetary theory, and that seemed to provide a bit of a coherent description of the economy to me. But some of the claims are quite bold and obviously very jarring when you compare them to the sort of mainstream rhetoric, the mainstream commentary that we hear from politicians and in the media. So I suppose I made it a bit of a goal for myself to try and answer the question: are these claims true in the context of the United Kingdom? And I met a few people online that were like-minded and had similar interests. Richard and Neil, who were two of my co-authors, and I guess over probably over the next decade, it took a long time, we managed to gradually put together a sort of suite of information based on freedom of information requests and official literature that at least sought to try and tie all of these different institutions and all of these different procedures together. I should say that we then worked with Asker and Josh, who are certainly currently more kind of academically minded, and put together some additional papers with them, one of which has been peer reviewed and is the one that you've cited at the start, and should be published officially by the Journal of Economic Issues soon.
Fascinating. Well, I mean, that is absolutely fascinating that you started on this from a purely layman's perspective, and I think so many people will identify with that who are in the I suppose the independence movement in Scotland, but also the MMT movement across the UK. You saw that something was wrong. You started looking for the information, couldn't find it. So a lot of people are in that similar situation, but you did something fairly different from what most people do, and it's that you actually delved really deep into it and ended up co-writing a wonderful academic paper. But that's a really interesting journey. I'm just going to bring Karen Van Sweden on screen now, who's joined us. Hello, Karen. How are you doing?
I'm good. Yeah. I'm just here. Hiya.
Nice to see you. Well, just in time for that first question. Then I think that so there's a lot of ways that you can ask this question, but I wanted to take something from a paper which is perhaps even more important than the self-financing state. And this is a paper by Stephanie Bell, who's now Stephanie Kelton, written in 2000. And the title of her paper was "Do Taxes and Bonds Finance Government Spending?" Now in her paper, which concludes that bonds and taxes do not fund UK government spending, she wrote this line. I thought this was a wonderful way to introduce to your paper: that such a treatment could have gone uncontested for so long is perhaps surprising. Indeed, some readers or listeners to the show may resist accepting the claims made in this paper on the grounds that they would, were they correct, surely have been made long ago. So an opening question for you, Andrew: why do you think it took the five of you, a group of non-monetary operational academics, so long for anyone to delve into the details of how the UK government creates, spends and destroys money?
It's a good question, and I can't claim to necessarily have a strong answer. It's interesting. I mean, we might go on to this a bit later, but this stuff has been written about before. You know, there are syntheses that link together the government, the Bank of England, monetary policy, fiscal policy, and all those different flows. And of course, we discovered them when we started to undertake this work. It's just that they seem to have dried up in about the 1970s and 1980s for some reason, and it's not necessarily obvious to me why that is.
So you're not blaming Thatcher and Thatcherism for that, then? It's just a coincidence.
I mean, yeah, that's. I mean, I do think there's room for a kind of a cynical interpretation of this, but I suppose it is worth making the point that, you know, our work is not the first, but it's the first for several decades, I would say, as far as I can tell, and it's the first since a bunch of different potentially important institutional changes have been made. So in the early 90s, we had reform of the gilt market. We then had in 1998 the Bank of England Act, which gave the Bank of England its, you know, somewhat limited independence, in my view, but also the emergence or the establishment of the Debt Management Office. And then in the 2000s, there's some changes to what used to be called the Office of the Paymaster General, now Government Banking Service. And then we get into different monetary policy systems such as interest on reserves and then quantitative easing. So there's been quite a few big changes from the 90s onwards, and from what I can tell, none of those have been written about in a kind of coherent, synthetic way where everything's knitted together in a synthesis. And that's the context I think that our work has appeared and hopefully filled a gap.
Yeah. So, and interestingly, this hadn't happened for such a long time, but it's wonderful that you've done it now because there's so much has changed over this kind of neoliberal period. Well, what you and I have picked out kind of 5 key takeaways that we'd like the audience to get, and we're going to go through these with a few questions to highlight them, and then we're going to open up for questions and comments. So, the first takeaway that comes from this paper I've written as government spending is a process of money creation, not dependent on tax or borrowing. So the UK government does not need to collect taxes or issue bonds before it can spend. So can you explain the legal and operational mechanics that allow government spending to occur without prior revenue collection or borrowing? And at the end of that, just briefly introduce us to the consolidated fund.
Yeah, I mean, we can. I guess we can analyse the process through which the government goes when it spends, and really, there's no reference at all in that process to taxing or borrowing. There's a very well established legal structure and set of steps that are taken legally through that spending process, and yeah, it's not dependent on a tax receipt or revenue from borrowing. I should give a little caveat in that tax is important, but in a way that is not usually discussed. So we can maybe go on to that afterwards. But to give hopefully sort of a brief description of the process, yeah, we've got this entity called the Consolidated Fund, which is at the heart of government finance. It's really the very heart. It's a legal entity which all revenue and all spending is linked. But although it's not usually discussed in the mainstream at all, so you know, it wouldn't surprise me if a lot of people haven't heard of the Consolidated Fund. But the legislation which governs government spending is something called the Exchequer and Audit Departments Act 1866. So an act of Parliament from 1866 still governs or underpins the government's spending process. That's how old it is. Although even before 1866, the processes were very similar. So what I can describe is at least 200 years old, and you could argue even older. And so basically, the process starts with Parliament passing a spending bill. So that's an act of Parliament that is passed, which authorises spending from the Consolidated Fund. Now, there's 2 types of spending from the Consolidated Fund. There's these things called standing services and then supply services. Standing services are types of government spending that are just permanently authorised. Examples of that are interest on government debt is permanently authorised. Other examples are, HMRC can repay, can provide tax rebates to citizens, individuals. Permanently, that's permanently authorized. It doesn't need to be authorized each year, for example. So, and there's lots of other different types of standing services, civil service pensions and things like that. And then we've got supply services. Supply services are the things that we probably normally think of when we think of government spending, such as, you know, the funding that goes to different government departments, such as Department for Health, Department, the Ministry of Defence, blah blah blah, and these are passed on an annual basis. So we have these annual acts of Parliament called Supply and Appropriation Acts. So it's 2 different types of spending acts of Parliament: standing services and supply services. Some are permanently authorised, some are authorised on an annual basis. But in both cases, the spending mechanism is basically the same. Parliament passes the spending bill, which says X amount of money can be spent out of the Consolidated Fund for this purpose, either permanently or renewed every year. And once that's been passed in Parliament, Parliament has authorised that spending. And then under the terms of the Exchequer and Audit Departments Act 1866, the Treasury can then request money for that spending to be undertaken. The process which then occurs is there's a civil servant called the Comptroller and Auditor General, who today is the head of the National Audit Office. When the Treasury requests some spending, that role has to check that the request and the spending has in fact been authorised by Parliament. And once that is done, they can grant what's called a credit on the consolidated fund account at the Bank of England. And once that credit is in place, the Treasury can then order the Bank of England to issue the money to what is known as a principal accountant. In this case, the principal accountant sits in the Government Banking Service, which is kind of the government's internal bank. And once that step is complete, the money is there, it's available. It can be spent by whichever department it was allocated to. Now, I guess there's something else which is kind of obvious when you look at the history of this and you look at the current system, and that's that the government has never really maintained balances of cash. I mean, I assume most people think that there's a big pile of cash that piles up, with tax receipts and maybe borrowing receipts, and then the government can spend. So there's some big bank account somewhere, presumably in the Bank of England, that the government spends out of. However, the government has never really maintained appreciable bank balances. It's never been its policy. In fact, it's always been its policy to essentially hold no cash at all. And we see that today.
You mean not cash, but digital currency? You mean?
Yeah. It would have been cash in the past, but digital currency today. I guess I would call money in an account at the Bank of England cash, because it's basically sterling. But I can see why that's a confusing term. But the point I'm making is that the government does not maintain balances greater than zero. Essentially, it's not its policy. It's its policy to keep, and it always has been for the last couple of 100 years, to keep balances to an absolute minimum. So, and today it actually zeros the accounts that I've just talked about. They're zeroed every night, so they start every day with a zero balance. And of course, the spending happens anyway. 400 million of pensions go out every morning, and the checks do not bounce, despite there being no money in the account that they've come from.
Okay, well, that's a really good summary, because what you're saying is the process is the government says we want to spend this money, and the institutions of government say, okay, well, let's make sure this money is available in the government bank account for it to spend. That is the process. And as you mentioned at the start, taxes are important in our economy, but not to be used. They don't provide any inflow into that fund to allow the spending of the taxes, and the same for borrowing. So that's an institutional approach when you've actually looked at how the operations work, rather than looking at a textbook and saying this is what economists say works. So that's a really clear principle kind of understanding for us. So very briefly then, how does the notion, the idea, the existence of the consolidated fund challenge the idea of taxpayers' money funding public services?
Yeah, well, I mean, the process that I've just described shows that the spending is not contingent on the receipt of the tax. It's not contingent on any balance at all. In fact, what I would say is the importance of tax is anchored to the consolidated fund. In the Exchequer in the 1866 Act that I've described, one of the stipulations is all revenue that goes to the government, with the exception of national insurance, which came a few decades later, but all other revenue has to go into the consolidated fund. So tax does go into this account. It's just that it's not necessary. The accumulation of tax receipts is not necessary for the spending. The two processes are completely decoupled, both in legislation and in function. So the spending can happen regardless of the tax. However, what I would say is the role that tax does play is that tax makes government the most creditworthy agent in the economy. No other entity, even if you're Bill Gates or Elon Musk or whoever, no other entity has the ability to tax people, and that gives the government a completely unparalleled command over the nation's resources. So it's the most creditworthy agent in the economy. We maybe get onto this later when we talk about the Bank of England. But what it means is that the government's really at the heart of the monetary system. Although we're usually told the government's some sort of passive user of someone else's currency. The government's actually at the heart, and the consolidated fund is right at the heart. So all of the liabilities that the government issues actually underpin all of the other types of monetary instruments that we use. And there's actually a phrase in legislation which says that the money expenditure arising out of the consolidated fund will be charged on the growing produce of the consolidated fund. And for a while, that phrase puzzled us. What does it mean, the growing produce of the consolidated fund? And then thankfully, there was, I think, a second secretary to the Treasury in the 1950s, Sir Herbert Britton, wrote a book which I read that explained what that means. What the growing produce of the consolidated fund means is the stream of future tax revenue. And what that means is the legislation in the UK literally states that the spending that the UK government does is essentially credit that is issued on the back of the future tax income. So when we normally think about tax coming in first and then spending happens, it's really the way around. The tax happens in advance of the future taxation.
Okay, so that was so that's interesting that you got to the heart of that. So again, just to summarize before we move on there, so the consolidated fund does have inflows of taxation. It does have inflows from other government revenue. However, none of that is needed to be able to issue any order to spend. So these are two separate processes. It's just the one fund that's taking money and spend. Okay, fantastic. Well, that's just covered taxes briefly. The flip side to that in terms of government expenditure is bonds. So the issuing of debt. So the kind of second takeaway we've got here is the purpose of public debt has shifted. It's not about funding expenditure. So from your paper, in modern UK operations, debt issuing serves monetary and financial system purposes, not funding. And bonds provide safe assets and collateral for the private sector and help implement monetary policy, especially in the regime of excess reserves, which is where we are now after kind of post-quantitative easing. So a couple of questions on this. If bonds are no longer needed to fund spending, why does the UK still issue them? And can you explain what the full funding rule is?
Yeah, the full funding rule is a rule that the government imposes on itself. I think it has done since maybe the mid or late 80s, which says that it will match all of its deficit. So the difference between spending and tax, it will match all of its deficit by the issuance of public debt. So in other words, the amount of debt that will be sold to the public will be exactly equal to the deficit. Now, the fact that that's a rule at all, a self-imposed rule at all, tells you that it's not necessary. If the government literally had to borrow money before it could spend, then its deficit would already be matched by debt, on a day-by-day basis. But it's not that that's not the case, and therefore, if the government seeks to do that, it has to declare it as a rule. And so, if the government's deficit is going to be 200 billion in a particular year, it projects that its spending will exceed its tax income by say 200 billion. Then it says we'll issue 200 billion of government securities, gilts or treasury bills.
Okay, so that is a choice. That is a choice to have that full funding rule. But what you're saying, it's not an economic necessity. The system doesn't need that. It's just a choice that the government undertakes.
They first made the choice in the late 80s, I think, when they were struggling with inflation, struggling with sort of in the wake of the monetary policy experiments. Then when interest rate targeting took over in the early 90s, and then obviously became the dominant sort of paradigm after the Bank of England independence, then at that point the full funding rule arguably made sense, because essentially what it amounts to is, if the government is, because obviously as I've just explained, when the government spends, it creates money. When it taxes, it effectively destroys money. The narrative around that is a little bit more nuanced, but it effectively destroys money. So if a government has a deficit, then it's creating more money than it's destroying. So it's adding money to the economy, essentially, if in a deficit situation. Now, when you've got interest rate targeting as a monetary policy, then if the government's continually creating money and adding money to the banking system because it has a deficit, then that can cause the Bank of England to lose control of its interest rate targets. Essentially, it puts downward pressure on the interest rates that banks trade between themselves, and therefore you can argue under that paradigm that the full funding rule makes sense. At least I'm sure that's what the government and the Bank of England would argue. However, I guess the first thing that should be clear with that story is that, okay, so the sale of government debt is not to fund the government, but it's to manage interest rates. So you immediately see that the point of government debt issuance is actually about interest rate management. So, if one quick reflection on that would be, well, in the last couple of years, we've spent 80 or 100 billion a year on interest payments, purportedly because we're having to borrow money, or at least that's what the mainstream rhetoric is. But actually, it's to support our interest rate targeting monetary policy, which we continually tell everybody is the only way to manage inflation. So at the very least, we should be clear that the issue of government debt is for monetary policy purposes, or was for monetary policy purposes back in the 90s when this system was set up. It was not for funding government spending. Fast forward a couple of decades, and in 2006 the Bank of England switched to a framework where it was paying interest on reserves. And then
I just want to clarify. So reserves are the currency that commercial banks hold with the Bank of England. So all commercial banks have got a bank account with lots of currency in it, and the government decided to start paying interest on that currency.
So the way that monetary policy usually sort of bites or affects the economy is through the accounts that the banks have at the Bank of England. So banks. At the end of each day, some banks have positive balances at the Bank of England. Some banks have negative balances, depending on the transactions that have flowed through the banking system, and therefore banks lend to each other. And the Bank of England, in trying to control the interest rate environment across the whole country, seeks to influence the interest rates that those banks trade with one another at within those accounts that they hold at the Bank of England. And
okay,
so,
well, Andrew, I'm going to, because I think that this is, and it's my fault, this has taken us off really from where we were going to highlight, which is that bonds don't issue, bonds are not issued for funding, and I think you've stated that really clearly. And we've started to get on to what is the role of bonds then. Why do governments issue them if they don't need them to finance? And you're saying it's about interest rate management, and it's about making sure there's enough liquidity in the reserve balance accounts. So they provide a very valuable function, but not financing. Is that a fair summary?
It's a fair summary. It's a valuable function if you think that interest rate targeting is the best form of macroeconomic management that we can do, which I don't. But if you accept that paradigm, then the issuance of government debt is arguably useful, except for the fact that we've now had QE, which has flooded the banks with much bigger balances in their reserve accounts, and the Bank of England pays interest on reserves, which means that it's actually the interest that is paid on those accounts at the Bank of England that is how the Bank of England controls interest rates. It's not by issuance of government debt anymore.
Yeah, and this is setting a floor and a ceiling, isn't it, where you have interest on payments and interest on reserves. Okay, so before we move on, I often say as a kind of shorthand to people that taxes and borrowing account for government spending, but they don't fund government spending. Is that something you would agree with, or should I change that?
I mean, they tend to match, where they have to match. The spending matches the taxation and the borrowing in the current system. So they end up being equal by design.
And that's the accounting. If you look at the accounting rules, it's that these things have to match. That's the accounting. That's the accounting of it. But yeah, about matching the spending. Okay, brilliant. Well, we're going to move on to the third takeaway, which is that the Bank of England and the Treasury are functionally unified despite this idea of independence. So the Bank of England is operationally independent. I think that's what it says in the 96, 97 Bank of England Act. The system's designed that it must accommodate government spending once it's authorised by Parliament, is how you've said it. Central bank independence does not imply that there's a hard limit on public expenditure, or that the Bank of England can effectively do what it wants. So what did your research suggest about the actual operational independence of the Bank of England? I'm not expecting that, is it independent or not independent, but kind of where did you come down on that when you looked at the evidence?
Well, I mean, what is usually described as independence is the Bank of England Act 1998, and in the wording of that act, it simply states that the Bank of England will be independent for monetary policy purposes. Now, the bank has other functions. One of those functions is being a banker to the government. That's not part of monetary policy. So therefore, and as I've just explained, there's other legislation which governs how the UK government compels the Bank of England to spend. So that's nothing to do with the independence. The bank is not independent to bounce the government's checks. It's independent for monetary policy. Now, interestingly, monetary policy is not defined in the Act. What falls under monetary policy, I suppose, it could be argued. Maybe someone wants to take the bank to court and argue over what that is. I don't think it's happened yet. But certainly around the time when the Bank of England Act was put through Parliament, all of the talk was about interest rates and the ability to set interest rates. So I think it's pretty much understood politically that that's the interpretation. They're independent to set interest rates. Now, of course, the government owns the Bank of England. It appoints. The other thing that came out of the Act in 1998 was the establishment of the Monetary Policy Committee, which would decide on interest rates. It's 9 members, I think. The government appoints all of the members, at least I think about half of them directly, and the others
That's right, yeah.
It authorises. And the government also defines the definition of price stability, which is the main remit of the Monetary Policy Committee. And the government also is able to direct the bank in times of crisis for the national interest and that sort of thing. Now, yeah, I think so. What I would argue is the role of, or the independence of the Bank of England is limited. It's limited to monetary policy, whatever that means. It doesn't affect the government's ability to spend. But then even for monetary policy, you can look at that and question how independent the Bank of England is. The reason for saying that is that I guess the most the most sort of significant monetary policy initiative over the last decade or so, quantitative easing, for example, was indemnified by the government, and therefore every change had to be authorised by the government. The government also the government also backs the note issue. So when banknotes are issued, the government backs that reflexively. There's legislation for that, and the government has a capitalisation framework whereby it will, if the bank's capital falls below a certain threshold level, the government will recapitalise it. So it seems to me that we're often told the bank is independent; it has to be able to make its own decisions. Yeah. But we never question, would the bank be able to function without the government and without the recapitalisation and indemnities that the government provides? And that's been at the forefront of the main monetary policy over the last decade. Yeah. So that suggests to me that the Bank of England isn't really independent. It's independent in the sense of a child having its parents' credit card, I would say. Okay. The Bank of England can make decisions. I mean, I mentioned earlier that government debt is issued essentially for monetary policy purposes. Yeah, yeah. So all of the interest that we pay is because of monetary policy. When the bank chooses to put interest rates up from 0 to 5%, as it has done over the last 3 years, that has an enormous implications for the government's fiscal policy. And the Bank of England has independence to do that despite the massive impact it has fiscally.
I think that is a really important point to make, that with that independence comes the ability to inject money into the economy, and that money takes up some space that fiscal spending, government spending on housing, health, education could have. So it has a significant, even though that element is independent, it still has a huge impact. And I think that's something people should go away and think about, is should we have unelected group of technocrats, economists, who are able to make such a hugely important decisions with very little oversight and understanding from the public. I think that's really important. And my final point would be, one of the main roles of the Bank of England is to ensure financial stability in the UK financial services system. So this ensures that the government and the Bank of England are working in tandem, because both of them have the same objective. So they've got to be, for this to function, to be singing from the same hymn sheet. And we saw what happened in October, September 2022, when Liz Truss and the government did something that was contrary to what the Bank of England were doing. A conversation and maybe a weekend might have stopped the mess that actually ensued. But this is evidence what happens when they don't work together again. So I think this all is really good evidence for backing up your idea that there is some independence, but it's not an independent.
Just on the stabilization thing, like the Banking Act 2009, explains how banks can be rescued, and that involves the government stepping in and taking over the bank, and the consolidated fund is drawn upon. The Bank of England doesn't do that. The point here is that the institutions that form our banking system are rescued by the government, not the Bank of England. The Bank of England, it's the government that is so creditworthy that it can support these institutions, including the Bank of England, but also private banks that create the money, that create the money that we use. Secondly, we have this thing called the Financial Services Compensation Scheme, which is the deposit insurance scheme in our country, where bank accounts are insured for £85,000 each. The Bank of England is not providing that insurance; the government's providing that insurance. So again, it's another signal that it's the government that's underpinning both the Bank of England and the entire banking system and the monetary system. The creditworthiness of the private banks is based upon the creditworthiness of the government. Can I just say one thing about the Liz Truss? The Liz Truss event, the thing that I find funniest about it is that I've never heard anybody talk about is that the government made £4 billion out of that whole event. But it's never, the Bank of England made it, but then that was remitted to the Treasury. So the Bank of England's intervention, buying up all the gilts when the fire sale was going on, and then selling them back to the pension funds over the December and January that followed, earned the Bank of England £4 billion, and that was remitted to the Treasury, and it's never mentioned.
Yeah, that is an interesting little asterisk to put onto that, isn't it? Well, just very briefly then, because I want to move on to the next takeaway, but we've got something called the Exchequer Sweep and the Ways and Means account. And could you just kind of mention again very briefly what they are, and how maybe you could say, well, this proves the taxation or taxation in some way is funding expenditure?
Yeah, well, so every day we have accounts at the Bank of England. The consolidated fund is at the heart of that, but then there's other accounts, one called the National Loans Fund, one called the Debt Management Account, and then a sequence of other accounts, the Office of Paymaster General account, blah, 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 all the departmental accounts. And essentially what happens is when all of those accounts are zeroed overnight, because they're all funneled into one account. So the positive and negative balances are all added together, and whatever the residual is, that's what the Debt Management Office has to deal with on a daily basis. So that might mean selling government securities, or it might mean buying back government securities if the government's left with a surplus. But at the end of the day, all of those accounts hit zero, and the net result of the government's transactions over the day is always expressed as changes to government debt outstanding held outside of the government, if that makes sense. So the government never accumulates cash balances. The cash balances never change. The cash balances are always zero at the end of every day. The only thing that changes is amounts of government debt held outside of the government each day. So the sweep, what you describe as the sweep, is this process of consolidating all the accounts together at the end of the day to figure out what that residual is. So if you think about the start of the day, all the accounts are at zero, including the consolidated fund. A load of spending goes out. Spending goes out. A lot of the spending goes out as backs payments. At 9:30 in the morning, hundreds of millions. So that spending goes out. That puts the consolidated fund into deficit. But then through the day, the debt management office will be doing its trades, trading, its repo trading, its selling of securities, and tax will be arriving in the accounts of HMRC.
And just an important point there is that the debt management office, they've got some idea of how much taxation is going to come in. They don't know for definite, but they've got a good idea. So at the start of the day, they've got an idea in their head that they probably have to sell 100 million's worth of government securities or buy 100 million. And this is monetary. This is a monetary, open monetary operations, isn't it? The government is constantly buying and selling debt to try and get into a position where it wants interest rates to be, or to kind of get this zero balance in the consolidated fund.
That's right. Yeah, absolutely. Yeah. So the debt management office works with forecasts, and there might be some changes late in the day that mean it has to respond quickly to those. In some cases, it might miss its targets, but it only has to have a zero. It has to zero these accounts over a week, so there's a bit of wiggle room on a daily basis. But in any case, the spending goes out, and then the receipts from the debt management office and from HMRC only then hit the consolidated fund at the end of the day when this sweep happens. So in the interim period through the day when all the spendings happened, there have been no injections of money to the consolidated fund.
It just grows. It just grows a
deficit, and then by the end of the day, the intention is that deficit is brought back up to zero. So you can see
a really important point there is to say that that the government is selling and buying bonds all the time. So when we hear that the government has to step, so let's say if the rise in yields a couple of weeks ago, and the government, I saw in the Independent someone said the Bank of England has to rescue the government, and I kind of thought it's a bit like saying the doctor has to rescue the patient, because that's the job of the debt management or the Bank of England, whoever. It's their job to buy and sell government debt to get it to a position where it's landing on the interest rate, the overnight rate that we want, or that zero fund. So when you hear about the Bank of England stepping in to buy bonds, that's what it does, and sell bonds, that's what it does absolutely every single day. So I think that is a really important point. Okay, well, I'd like to move on to our next one then, and then it's just really to say that this was the first detailed look at this, as you said, for at least 40 years, and after all of these funds. So a few I suppose a couple, and then we'll go to questions from our audience now. But this is touching on the political economy of it, I think. But we asked kind of like, why has this not been done? What are the consequences of this lack of understanding of how the institutional design of the UK monetary operation affects government expenditure? What impact does that have on the kind of wider politic in your views?
Well, you could probably figure out where my politics are when I answer the question. But I mean, I would say things like austerity are possible. I don't think in 2010. I mean, this is why I started to look into this, because I wanted to understand, is this really imperative or not? But it was presented to the UK. Austerity was presented to the UK public as an economic imperative, and the UK voted for it. Now, I don't think anyone would vote for it if they knew that it was a choice, and they knew that there were other options are available. But the framing that we see in our sort of public discourse is that no, the government's a currency user, not a currency issuer. The government isn't the most creditworthy agent in the economy that underpins the entire financial system. No, it's a user of currency. It has to go around with its begging bowl, trying to find money. And if we can't have, if we just can't find that money, then we can't have good services. We need to have austerity. And yeah, that has to be presented as an economic imperative, I think, in order for people to accept it. They wouldn't accept it if it was just described in its correct terms, I don't think.
Yeah, and so what you're saying, it's an ideological framing that this discourse allows this position where we're, you know, as you said there, we're moving towards austerity. I would say it also says things like we need the wealthy in our society because it's them that we tax, and it's their money that we borrow. So that has a big implication on where you are in terms of inequality and having a level and a just society. So huge issues around that. And sorry, we can only very briefly touch on that because the final question I've got for you before I move to the audience is that this kind of takeaway, this fifth takeaway, is that debt and deficit framing obscure the functional role of public finance. So one question on this then, how should we rethink the language of debt and deficit in light of your findings? I know that Stephanie Kelton and other MMT economists say, hey, don't call it the public debt, call it the public savings. But what's your thought on that? And then we'll go to the audience for questions.
Yeah, I mean, I think that's the right way to view it. I mean, the one thing that I think is important to understand is that the government doesn't control its deficit. The deficit, we were told by George Osborne, and I think we're kind of being told by Rachel Reeves that, you know, the government can bring down the deficit or reduce the deficit, but the government doesn't control the deficit. The deficit is decided by the activity in the economy. The government might set its spending as an absolute quantity, but it doesn't set its tax as an absolute quantity. It sets its tax as a relative quantity, proportional to the economic activity in the economy. And that economic activity is based on the decisions of you and me and everybody else in the economy. What do we choose to buy? What do we choose to spend? Do we choose to spend abroad? Do we choose to put our money under the mattress? You know, and that's what affects the deficit. And so the government doesn't affect the deficit, doesn't control the deficit. The private sector controls the deficit. And once you understand that, you realize how futile it is and silly. And
to have that figure and that target,
to think that the government can and should target it. Now, once the deficit runs for a few years, it then accumulates into a debt, a stock of outstanding debt. That, you know, the deficit is the flow, and the debt is the stock that accumulates over many years. And we should view the stock, that stock of government debt as assets, financial assets that are in our hands. You know, like we mentioned earlier. Well, the government's debt is like a form of money, and it fulfills money-like functions. It serves as a medium of payment, particularly in wholesale markets. Essentially, government debt is the money that you need to be able to buy Bank of England money, Bank of England liquidity. It's the word used in that context is collateral, but you know, we can think of it as you spend gilts or treasury bills to buy money. It's also used as a store of value, particularly for pension funds. You know, so anyone who's got a pension is probably invested in government debt. And the reason for that is simple. You know, you don't want to, if you've got £1 million, you don't want to put it in a bank because you're only insured up to 85,000. And considering that insurance is provided by the government, you can see why just holding one of the government's own securities is actually essentially fully insured. You know, so the government securities are a safe store of value. So for anyone who's saving a lot of money, you want them in government securities, not in a bank, because they're essentially fully insured. So that in that sense, you can see how the debt is fulfilling money-like functions. And for that reason, it's demanded just like we demand coins and notes and bank balances. We demand government debt because they're part of the same system. And in that sense, it's exactly correct to think of them as our savings. And in a sense, the deficit, the cumulative deficit that the government runs is providing a pool of money, essentially, or a pool of monetary instruments that provides for our financial wealth.
Fantastic. Well, It's nearly a 40-page paper, so I hope we've given it justice in kind of 45 minutes to go into this. But I do, we've got a link to the paper in the comments here, and I'm going to take some of your comments. And Karen, if you've got any thoughts or a question, then please. But I'll ask a few from the audience first. So thank you very much for that, Andrew. Okay, so I'll go to a question from David Murray here. And this will be going back to the consolidated fund, but do tax receipts trickle in constantly, or is it in batches?
Well, I guess there's probably a couple of different answers to that, depending if you're talking about through the day or if you're talking about through the year. I mean, I think there's a well-known kind of seasonal aspect to tax, whereby the last few months that we've just gone through tend to have the large tax receipts, and I think we saw in February or maybe March, the government had a surplus, and you see that mentioned in the news. And it's sometimes not mentioned that it just happens every year. The government goes into surplus every year around that time. So there's definitely a seasonality to spending and taxing. Through the day, though, from what we can tell from freedom of information requests, tax will hit HMRC accounts in particular constantly through the day, and then they transfer. The HMRC hold accounts with Barclays at the moment, so taxes hit accounts in Barclays constantly through the day, and I think several times a day they make transfers to the Bank of England, the HMRC accounts at the Bank of England. That's maybe 4 or 5 times a day, I think. Something like that, and then at the very end of the day, the HMRC account at the Bank of England will transfer the taxes into the consolidated fund.
Great, and of course the government wants to take this money out of the other reserve balance accounts, doesn't it? As soon as it can. So that's why it's doing it. It's just doing it again to help it kind of maintain the right amount of reserves that it wants, and to enable it to be able to buy or sell the bonds. So this is something that happens consistently. Charles, I'm going to put this up. I'm not sure in detail what you mean here. If you want to drop me a note. Andrew, any thoughts? Is there a link with the City of London? We can just pass on that if you're not too sure, and I'll ask Charles for more clarification. But
yeah, I don't know.
Okay, Charles, please do. Yeah, please do. Martin's got a point here. What's your thoughts on this? There's no guarantee when the government would pay the 85k. So this is the deposit insurance. So I think, Martin, what you're saying is, yeah, the government will pay, but it doesn't say will be paid within 30 minutes or 30 days. Is that your understanding?
I don't know about that. Yeah. Martin may be very well correct.
Yeah. Okay, great. Thanks for that, Martin. Let's see what else we've got. Yeah, here's an interesting question from Hashford here. What influence does the credit rating agencies have on the Bank of England? I think there's a simple answer to that.
I don't really know. I can't really elaborate, but I would say none. It depends what you mean. I mean, I don't think the credit rating agencies, they certainly don't have an impact on the credit worthiness of the Bank of England or the credit worthiness of the UK government. Whether or not some people buy into the pronouncements of credit rating agencies is another question, and I don't have enough expertise on that.
Yeah. So the credit rating agency could say that government debt's is AA rather than AAA. Or something like that, couldn't it? But not directly on the Bank of England. Okay. Again, feel free to give us your thoughts on this, not your expert opinion. Would an independent Scotland issuing its own currency need to issue bonds, in your opinion? If not, how do you think other central banks would react? Thank you, David. That's a really good question. So 2 questions. Let's do the first one as more of a technical question. Would an independent Scotland issuing its own currency need to issue bonds?
Well, it depends what you think the role of bonds are. If the role of bonds is to borrow money, I would hope not. I would hope an independent Scotland would understand the nature and benefits of being a sovereign currency issuer. So you wouldn't issue bonds to raise money to spend. You would just issue money. Would bonds be issued to maintain interest rates as they were in the sort of 90s and 2000s, and arguably now, although with caveats? Well, if an independent Scotland adopted an interest rate targeting monetary policy, then possibly you'd need to issue bonds. But there are alternatives to interest rate targeting and monetary policy. There are other things that can be done to manage inflation, and when there's a lot can be said about interest rate targeting monetary policy, but the main thing that I'm thinking about at the moment is the fact that we're spending 80 or 100 billion pounds every year paying interest to the most wealthy people in society. It's like the most regressive system you could imagine, and therefore I would like to think that there are alternatives to interest rate targeting that don't have that deep flaw, in my view. So I would like to think in independent Scotland, which is where I live, would not issue bond, would not adopt an interest rate targeting monetary policy, and therefore it wouldn't issue. But now, would you then issue bonds because they're a good savings vehicle for the population of Scotland? Again, that's something that could be considered. However, the thing that I would wonder about is, do we really need savings vehicles to be tradable, so that they can be traded? Can we not just have government backed, like what we have at the moment, national savings and investments? That would serve that purpose, and maybe you could open it out to pension funds or organizations like pension funds, rather than having this kind of casino type thing where we've got tradable government securities being traded domestically or maybe even internationally, and then we see the things like the LDI crisis happening when interest rates change.
And LDA crisis, you mean specific organizations who have got lots of government bonds and are buying and selling for their liquidity purposes?
But, well, when organizations are over leveraged on bonds, and then when interest rates change, that leverage environment completely changes. And I mean, that's what precipitated the LDI crisis following the Liz Truss thing. I think there was also some bank failures in the US around the same time for similar reasons. So you tradable government securities, I guess may have implications for economic stability in that sense. I don't know if I would suggest that there are better ways to provide for savings vehicles for the population.
Brilliant. And this is where I think it really helps anyone in Scotland, certainly anyone who's thinking about Scottish independence moving forward, to properly understand the institutional role of bonds. And we can't be in a situation, which is where we are according to the latest Scottish government paper, which is simply to grandfather everything that happens in the City of London for Scotland. So Bank of England, but there be a Bank of Scotland with a slightly different name, doing everything the same, starting from the same position, paying interest on reserve balances, offering bonds. We need to be in a situation where we take a step back and we say, well, let's look at every single part of this individually and decide if this is right for Scotland now, not simply take it as it is for the UK, because it's clear it's not even correct for the UK. So it would be crazy to start from that position. And just that final point, if not, how do you think other central banks would react? So put yourself as a central banker in the Bank of Norway. Would it have any impact on anything that you did if Scotland didn't issue bonds?
I don't know. It might be the fear of a good example. That might be the thing that they don't like. I don't know.
Okay, fantastic. Well, thanks very much for that, David. And we've got another question down the bottom. So I think this is Charles' extension to his earlier question. The City have by tradition seats in Parliament and the Lords, and just wondered if the links continued as far as the Treasury.
I don't know about that. I don't know. Yeah. I don't know if there's any.
Kieran, I know you've spoken before about the particular person who sits in Parliament, haven't you? Who is appointed by the City of London. So I think it's clear there's a really close connection between Parliament and the City of London.
Yeah, they're called the Remembrancer. Yeah, and they always sit behind, in front of the Speaker of the House. Yeah. So,
keeping their eye.
Keeping their eye. Yeah.
Okay, fantastic. Well, please, if you've got any final questions before we let Andrew go, I think it's really important, if I'm just see if any comes in, just to kind of summarize the importance of this paper. As you've said, there hadn't been anything that looked in this in detail for 40 years. There was huge, significant changes. And from an institutional economist perspective, what has happened is all of the institutions have changed to a great degree. but the understanding of the process and the impact of that process hasn't changed at all over that period of time. And if you think about any other sector of the economy or any other discipline where all of these fundamental things change, but we don't analyze it again to see if it has any real world impact, you'd be struggling to find any example. And I think what you've done is so crucial, because it allows us to start to look at this in detail and say, if this is what happens and happening now, and here's the evidence, what impact does this have, and how do we change things? And I think finally it starts, as you've mentioned a couple of times, it starts to put a lens on this idea that there's a choice, and that governments are making choices right now to pay a huge amount of interest on government debt, to prioritize that type of spending which goes to the wealthiest in society, rather than prioritizing the spending that goes to the poorest in society. These are choices. I think the paper really helps evidence that that's actually the case. Andrew, do you want to give us a final thought before we head off?
Well, just want to say thanks for allowing me to try and explain what I've tried to. It's been really enjoyable and a pleasure, and yeah, hopefully it's useful. Hopefully it's useful to people. And yeah, the next thing that we're hoping to look at is monetary policy. You'll have realised that I've mentioned a few times that I think. It's good to understand how the fiscal side works, but essentially the more you discover, the more you realize that, and the more you sort of win the arguments about how it actually works, the more you realize that actually everything's orientated around monetary policy, and it's monetary policy that I think is the issue. So yeah, hopefully
looking forward to seeing your paper on that.
Yeah, hopefully we can shed some more light on that.
Fantastic. We'll keep up the good work, mate. It is amazing, and it's hugely beneficial, I think, for all of the political as well as the economic lenses that you can put on government spending because of your work. Andrew, thanks so much. See you soon. Bye for now.
Thank you very much as well. Cheers. Bye.
Well, Karen, we had promised her well to get Andrew on the show. It is, for me, it was designed to be a little bit of a taster, because I do want everyone to go away and spend a couple of hours, as you and I have done on numerous occasions, print out that document, highlight it, quote it, share it, because it's a hugely important piece of evidence that really helps us get across this idea that the power, the monetary sovereignty of the UK government is absolutely crucial in an understanding and how the system works.
Yeah, there was quite a few things that he brought up, and I wanted to ask him, but I thought we could discuss it now. And I think when he's talking about funds, I think it's important that people don't visualize this as pots, which I think funds perhaps has the language of sounding like pots. And what we are really talking about is a spreadsheet and columns and rows on a spreadsheet. And although cash is used still to some extent, cash that comes back to the treasury is destroyed. So, it literally is, it is a spreadsheet. And bonds and tax are fundamentally currency drains. They're taking currency out of the economy. But as we've often discussed, fundamentally with bonds, you're giving people who have the ability to save money for long periods of time, you're rewarding them for that, and that's that's creating inequality in the UK and obviously in the US as well. So that's problematic in and of itself. Another interesting thing that he brought up was, obviously the interest rates on the bonds to an extent are giving banks an income, and I think it's perhaps something that governments need to think about in the future is having different interest rates, different banks in different geographies in different places. We're discussing a lot the energy, and zonal pricing at the moment. Should there be zonal interest rates? Should banks be offering different interest rates in different places in order to encourage growth in those particular areas? And I think that's something that governments need to think about. Savings, are they necessarily good for an economy? In the UK, it's different from countries in mainland Europe, where we're very much encouraged to be investors and have these private pension funds. But that money is then coming out of the economy, and it's not, circulating in the economy. It's there for, when someone grows old. And is that really clever? If you want to have a thriving economy, why don't you just make sure people have got a decent state pension? And if they really, really got a lot of extra money, then fair enough, they could invest in something like that's medium risk and high risk, say like ASDA shares, and then various more risky things. But really, should we be offering bonds for that? I personally, I'm not sure if we should, and I don't know if Scotland should be doing that in the future. I'm really not sure, but I have to think about that. And commercial banks are licensed by the government. I mean, I had a dig at someone on the train when he was asking me about what he was doing, and he was a banker. And, I said, well, fundamentally, you're a franchise for the government. You understand that, you're creating money.
Almost on behalf of
on behalf of the government, really, and that's fundamentally what you're doing. So, and the Bank of England, its independence and its objectivity, clearly there's questions on that. Looking at who's worked on the Monetary Policy Development Committee, there's not a lot of diversity there. I don't think there's been anyone Scottish on the Monetary Policy Committee, as far as I can make out. And so can that be objective and really think about what the whole...
I know Danny Blanchflower had suggested that Scotland, England, and there should be national appointees to the MPC, expand it, but have a Scottish and an Irish and or a Northern Irish and a Welsh person. I think there's a lot of talk about what you can do to, as I would say, completely tweak around the edges of the huge issues. But again, I think you've raised some really important points, and this again, I think, highlights what I hope that people would take away from this, is that if we have an independent Scotland, we have to look at everything that we do, and we have to look in detail at pensions and the role of pensions. And we have to look at the fiscal side of government spending and the monetary policy role. And the idea that this is just pretty simple and we just copy what England does and then we move on from there, I think is something that we've got to fundamentally avoid, because we all know once you've set something in motion, once you've started by copying the Bank of England, it becomes really difficult to change it. We need to take our time and we need to start doing that work now, so that when we are independent again, we are able to start with a much clearer idea of what we design and what we want for Scotland. So it's amazing that Andrew and the other 4 people on that report have started to do that work. It's really important. Kieran, thank you very much for joining us. We've gone on long tonight. I hope everyone enjoyed that. And as I said, take my hint and read that paper. In a couple of weeks' time, we're going to be looking at something similar, but we're going to be speaking around kind of climate finance and the role of private finance and government finance in generating money or resources to fight the climate crisis. So we'll be back in a couple of weeks' time. Until then, have a good time, and hopefully we'll see you online or at some various events over the next couple of weeks. Thanks so much, everyone. See you soon. Bye for now.
Bye-bye.